We received apologies today from Senators Marshall and O'Sullivan, and as I'll explain to our guests, there are a number of committees going on parallel, so if people are coming and going, please don't take it personally or anything, but unfortunately it's just the nature, but we'll do everything as best possible. I would like to remind members to ensure that their mobile phones are now switched off. This is important as it causes serious problems for broadcasting, editorial and sound staff, and we're very keen to make sure the transcripts from these are wholly accurate. Our first session today is implications for the Irish economy of the withdrawal of the United Kingdom from the European Union. I'm delighted to welcome Mr Mark Cassidy, Director of Economics and Statistics, and Ms Gina Fitzgerald, Head of Financial Risk and Governance Division, both from the Central Bank of Ireland, with their colleagues. We engaged with the Central Bank, I suppose it was 2 years ago now, when we drafted our initial report to this committee, and all things being equal, this committee would have disbanded quite some time ago. However, that hasn't come to pass. And despite the fact that Brexit hasn't actually happened yet, there is much that we still have to discuss. Indeed, much has occurred and impacted the Irish economy, the Irish banking system and so much else. Earlier this week, the IMF described Ireland as being uniquely vulnerable to a no-deal Brexit, so we are particularly interested in the Central Bank's analysis today. However, before we begin, I do have to remind everyone of the rules on privilege, so bear with me for a few seconds. Members are reminded of the long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the Houses or an official either by name or in such a way as to make them identifiable. By virtue of Section 17(2)(l) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to so do, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that, where possible, you should not criticise or make charges against any person, persons or entity by name in such a way as to make him, her or it identifiable. With all that covered, Mr Cassidy, I'll ask you to begin. Thank you very much.
Certainly. Thank you very much, Chairman. Thank you, committee members, and good afternoon. So we welcome the opportunity to appear before you today. I am joined by Gina Fitzgerald, who is the Head of the Financial Risks and Governance Division in the Central Bank. And in my opening remarks, I will very briefly set out the work undertaken in the Bank in relation to Brexit, as well as potential implications for the financial system and, in particular, the wider economy. So the Central Bank has been focused on Brexit risks since before the 2016 UK referendum. Following the referendum, a Brexit task force was established on a permanent basis. It meets and it reports quarterly to the Financial Stability Committee and the Central Bank Commission regarding Brexit-related political, economic and financial market developments. Also on risks arising for firms supervised by the Central Bank, as well as issues arising for the Central Bank itself, and in particular with respect to authorisations. In September 2018, the Central Bank also established a Brexit steering committee to oversee the further stages of the Bank's preparations for the UK's departure from the EU, focusing on cliff edge risks and the adoption of mitigating actions where possible and appropriate. So the Central Bank's work has focused inter alia on ensuring that, first, the risks to the Irish economy are understood. Second, that financial stability and consumer protection risks are identified and mitigated to the greatest extent possible, particularly in relation to the cliff edge risks associated with a hard or no deal Brexit. Third, that regulated firms deliver on their responsibilities of appropriately preparing their businesses for these risks. Fourth, that we develop our gatekeeper role in a robust, transparent and efficient way, consistent with our aspiration to operate to and influence with European norms of supervision. And overall, ensuring that Irish and European financial stability, investor protection and consumer protection risks are mitigated. So we have taken a transparent approach to this work, recognising the importance of and interest in it. We publish all the reports of our Brexit task force, as well as frequently asked questions. And we have held several Brexit-related stakeholder roundtables and have published numerous reports and speeches. So let me now briefly discuss our assessment of potential implications of Brexit for the Irish economy. The Central Bank's central forecast is that underlying economic activity is set to continue to grow at a relatively strong pace in 2019 and 2020, although some moderation in growth is in prospect, reflecting both the impact of a less favourable and more uncertain international environment and also the limits imposed by domestic capacity constraints and a tightening labour market. If a disorderly no-deal Brexit scenario can be avoided, then the outlook for the economy over the next 2 years remains broadly favourable. Economic growth is set to be supported by a still solid pace of expansion in domestic economic activity, underpinned by continued growth in employment and real incomes. The ongoing recovery of the construction sector and growth in domestic government spending will also help to underpin domestic growth. But as is now well understood, any type of Brexit will be negative for Ireland, with a disorderly no-deal Brexit especially so. In previous analysis, the Bank has published work examining the potential medium-term impact on the economy of, first, an orderly World Trade Organization or no-deal scenario, also a free trade area-like agreement such as the Withdrawal Agreement, and most recently, a disorderly no-deal Brexit. Even if a deal can be agreed, there will still be additional trade frictions which will have disruptive effects for businesses and consumers and for the agriculture and food sectors in particular. But on aggregate, the effects will be reasonably contained and spread over the medium term. A disorderly no-deal scenario, on the other hand, would have very severe and immediate disruptive effects, with consequences for almost all areas of economic activity. Compared to a situation where the UK remained an EU member, our estimates suggest that a disorderly Brexit would result in a substantial and permanent loss of output. The disruption and related decline in economic activity would be front-loaded and would give rise to a significantly more adverse outlook for the Irish economy in the first few years. Certain sectors and regions would be disproportionately affected, especially those which are more reliant on trade with the UK or which are more vulnerable to the imposition of tariff and non-tariff barriers, particularly sectors such as agriculture, food and smaller-scale manufacturing, and rural regions and those near the border. Brexit is not, of course, the only risk to the Irish economic outlook. On the external side, there continue to be a number of other downside risks facing the economy. Given the position of Ireland as a small, highly open economy and the important role of multinational firms within the economy, the evolution of global economic and trading conditions, taxation regimes and movements in major exchange rates will also have an important bearing on Irish economic performance. On the domestic side, while overall price inflation remains very subdued, wage growth has continued to pick up against a background where the remaining slack in the labour market is diminishing. And there is a need, therefore, to continue to guard against the risk that strong cyclical conditions give rise to overheating dynamics. Let me now briefly discuss implications of Brexit for the financial system. So on the basis of the specific Brexit work that we and others have undertaken, and crucially the work of the last decade to drive a significantly more resilient financial system, the immediate cliff-edge financial stability risks of a no-deal Brexit are considered to be broadly manageable, albeit that this eventuality will be challenging for all firms operating in Ireland. There are some remaining risks of consumer detriment. So the Irish and UK financial systems are closely connected, with UK firms and firms from Gibraltar providing financial services to Irish consumers. The Central Bank has worked closely with the European and UK authorities to seek to ensure that those firms wishing to continue to provide services to Irish consumers are able to continue to do so in the event of a hard Brexit. The majority of UK-based firms have taken appropriate action, but not all have to date. But in this context, I am pleased to note that the Central Bank has worked closely with the Department of Finance to support the drafting of legislation to protect insurance customers in event of a no-deal Brexit through the creation of a temporary run-off regime. The nature, scale and complexity of the Irish financial system is changing as a result of Brexit. New authorisations and expansions of existing operations are increasing the size of many sectors, and our gatekeeping role in this regard is hugely important in mitigating financial stability risks and protecting market integrity and customers in Ireland and across Europe. And it is imperative that any new business authorised here as a result of Brexit meets the high standards that are expected of any such firm authorised in the EU. We also continue to be active internationally to ensure that the risk of divergence between EU jurisdictions in how they handle relocations from the UK is mitigated. And in order to address the concern of regulatory divergences and the risk of regulatory arbitrage between EU member states, we have long been engaging closely with the European Central Bank, as well as across the Single Supervisory Mechanism and the European Supervisory Authorities, to agree European-wide approaches to the key policy and supervisory issues, stances and decisions that have arisen from Brexit. Following the UK's departure from the EU, there will be a loss of experience and expertise when UK regulators are no longer sitting at the table. The UK's departure will require increased engagement on our part in the relevant EU and international fora, and we have consistently and successfully been making a substantial effort in this regard since the crisis, and we will continue to prioritise our work in this area. London is a truly global financial services centre, operating within and serving a very material amount of the financial services needs of the EU. Undoubtedly, the role of London and its interconnections with the EU will change post-Brexit, and it is critically important for the EU economy and all its citizens that it continues to have a financial services system that delivers within the EU, but also has deep global connectivity beyond it, including with London. And we are now available and happy to take any of your questions.
Thank you very much, Mr. Cassidy, for the very, very detailed intervention. And I'd like to call on first Senator Craughwell, and I'm going to take everyone together, so if anyone else wants to come in, they might indicate.
Thank you very much indeed, Chair. I regret I have to leave very quickly after this. I have another meeting, but I'm really interested in your report, and where you speak about growth in the economy and growth in employment, if you want, and coupled with that, growth in real incomes. One of the huge concerns I have at the moment is if you look at our dependency on the big software companies in the country. We have reached a point where, first and foremost, these companies are now having to source accommodation for people they're bringing in from abroad. They're having to compete salary-wise within the country, within Ireland. And having spoken to some of the senior people in some of these companies, there is a real risk now that they will look elsewhere for cheaper accommodation, first and foremost, and cheaper labour costs. Our labour costs are competing internally rather than competing internationally in the case of these companies. Dare I say it, there is some suggestion we're back in the bad old 1995 to 2000 days where companies are having to bid for professionals. So one senior executive said to me, it wouldn't take a whole lot to have us move. And I wonder if you have looked at first and foremost, the threat there, and secondly, the likely implications for the economy. An old hobby horse of mine is the border. It has been a hobby horse of mine since the day after the referendum passed. You mentioned here in the agri-sector, if you want, I've always seen as part of our core economy. And I cannot see a way, any way, that we can have an open border. I've never been able to see it. Nobody has ever explained to me how you can have an open border with a third country, in particular if there's a hard crash out. I make the point before, all we need is one carcass of beef to finish up in Berlin or Paris that is not true Irish beef, that has something like angel dust or something in it, and our entire market collapses in Europe, which is about 60% of our beef market. So that's a fairly serious concern. I wonder if you guys have war-gamed the border issue and its implications. Clearly, the suggestion that we will have checks at ports places Ireland outside the European Union. if we're going to use Dublin Port, Cork Port, Rosslare as the point for checking customs, which is the suggestion that's been made. To my mind, that places us outside the European Union. If there are to be checks anywhere, they should be on the border. I know that some of our European companies are those manufacturing in Ireland who are sourcing component parts and raw materials through the UK are now being actively encouraged to look to Europe and to look at suppliers in Europe. Have we looked at the cost implications? Manufacturing costs, because costs is where it will all be in a post-Brexit world. So have we looked at the cost implications of shifting or purchasing to mainland Europe? And secondly, in replacing the land bridge, because I'm now convinced that the land bridge notion will not work out. Somebody suggested to me one day the British might lay on one carriageway to Dover for Irish trucks and one carriageway from Dover back for Irish trucks. Can't really see it happening. So the costs of a sea bridge, clearly you're talking about a 36-hour sail as against an 18-hour. But I wonder how the 18-hour... Has anybody, and particularly Central Bank, has anybody looked at the statistics, the time it's going to take to clear trucks? We're talking about 9-kilometre tailbacks in places, so the statistics on that. The other one, the SMEs in Ireland, the government, in fairness, have put on a number of roadshows talking to people about preparedness for Brexit. I was horrified at one of those meetings when they asked companies for a show of hands of who had a Brexit officer in place. And out of a packed room, 2 hands went up. I was absolutely shocked to see that. I wonder if you have any statistics as to where our companies are now. Have they at last begun to realise this thing may very well come down the line? And finally, partnerships. This is inter-country partnerships within the EU. Clearly, our strongest ally is going, so we may have to subdivide the European Union, if you want, and pick different partners for different topics. So we might go to the Germans for finance, we might go to the French for agriculture, and then pick some of the smaller countries to get a critical mass. Have you guys analysed which countries are most suited to which specific topics? So I hope that's not too far outside your remit, and I thank you very much for your time, Mr Cassidy, Ms Fitzgerald and your colleagues. Thank you.
Thank you very much, Senator Craughwell. I'm going to take a number of interventions in one go. And next on the list I have Senator Nash.
Thanks very much, Chair. I've really got a direct question, and it's really comparable to the shock experienced in 2008-2009. You might be frank about the loss of output that you expect to see in the event of a no-deal Brexit, the number of job losses, the quantum of business closures that you might expect to see, where those businesses are, what sectors they are. I think we know that, but I think it would be important for you to be clear on that. So in your opinion, in real terms, what are we facing as an economy and as a society in the event of a no-deal Brexit? Because the reality is that whether we like it or not, given the political climate in Britain at the moment, we could very well be staring down the barrel of that no-deal exit going.
Senator Nash, then I have Senator Paul Daly.
Thanks, Chair, and welcome to representatives from Central Bank. Just briefly, a couple of questions maybe to flesh out from your opening statement. While it's not maybe our remit, but it's very much related and will affect us. How far have you looked at, and I say it's outside your remit, but the British economy post-Brexit and the fact that sterling is a standalone currency, while they're not in the EU, in the euro, they're in the EU. So once they go, assuming they're gone, and the fact that we will have sterling currency on the island, have you looked at where that might go and how then it could and would affect us further down the line that may not have been in any of your stress tests to date? I'd also be interested to know about your research and your contact within the consumers in the financial sectors. How much previously proposed development within Irish industry and the Irish economic sector is parked with a view to the prospective investors or developers waiting to see Like while we have economic growth at the moment, and you're predicting, Brexit aside, continued economic growth, do you have a sense of a lot of development and investment that may well have had happened at this stage in the last couple of years, that the prospective developers or investors are sitting on their hands just in a wait-and-see kind of a game? And could there be, if hypothetically speaking, but also hopefully thinking, if this thing was sorted out anyway reasonably in our favour, could we see a little bit of a mini tiger then when people get off their hands that are waiting to see? And I suppose it seems to be negative when we're talking Brexit. Are there any positives? There's not much positivity in your opening statement, to be honest, but I can't fault you on that. You have to call it as it is, and a lot of it is speculative. But do you see, or have you experienced to date, even maybe some, positive spin-offs that may or may not have happened if Brexit hadn't have happened? Thank you, Chair.
Thank you very much, Senator Daly. Senator Ó Donnghaile.
Thanks, Chair, and apologies, Chair, to you and our visitors. I was up in the chamber on a separate bill. I've read over the opening statement, Chair, and while there is quite an understandable frankness to this in terms of the severity of the impact of Brexit, whether no deal or otherwise, and I agree with the assertion that any type of Brexit is negative for us in Ireland. I do wonder if you have a view on the importance and the significance of the backstop within the context of your own remit, your own work, and if you could maybe refer to that. I don't have a question at this stage per se. I may have off the back of what you say, but I just think it's probably an unintentional omission from the remarks that I have seen, just in terms of the significance of the backstop, as I say, in terms of your own remit, your own work, and the businesses that will be impacted as a result of Brexit. Thanks, Chair.
Thank you very much, Senator. I had a couple of questions of my own that I'm going to throw in, and most of them actually work off the back of points raised by Senators Nash, Craughwell and Daly. In relation, I was asking if you could put a little bit more detail, give us exactly more of the figures of what your prospective growth rates is, both in a deal scenario and indeed in a crash-out scenario. And I think we're only facing those two prospects, or indeed the possibility of a referendum, but we won't go into that. Just in terms of the growth rate for forecast, but then two other ones that I suppose have covered the period since the referendum to where we are today, in terms of how many new banking licences have been issued since the referendum, and overall, can you quantify the amount of increased activity in financial services in Ireland in that period, and would you have a projection about how much that could possibly increase? You alluded to it in your opening remarks, in both situations, either through a deal or a no deal. And I suppose others have mentioned issues about preparedness, but how best can we manage the cliff edge scenario? As Senator Ó Donnghaile rightly says, and I think I've said it at every intervention possible over the last 3 years, there's no such thing as a good Brexit in any form, but the cliff edge crash-out scenario is extremely worrying, and what increased measures can be taken to manage it, both in terms of government actors, but also economic actors, business actors, civic society actors. And as Senator Craughwell rightly pointed out, it's very hard to appoint a Brexit officer if you're also the CEO, head of sales, head of cleaning, MD of a business that employs 2.5 people, and you're working flat out round the clock. And the final one, and it's a bit more specific, and you allude to it directly in your closing paragraph. London isn't going anywhere. Even if it's a crash-out scenario and the British economy would decline to a huge extent, London will still be one of the world's major financial centres. And it's still going to be extremely important for Ireland and our financial services sector that we maintain a complementary relationship with the City of London. And I suppose it's how can we maintain that engagement? And indeed, secondly, what have we done so far to maintain that engagement? And I'm aware of quite a bit of work, and I've met more people from the City of London and various representative groups over the past 3 years than I ever thought I would have to. But I do appreciate them within the European context, and Senator Craughwell touched about developing alliances, but if we did get a deal scenario, or indeed in a no-deal scenario, the priorities of the Irish economy, particularly the Irish financial services sector, might differ from colleagues in the remaining EU 27, and how best are we to position ourselves both within the British economy but also within the EU 27, that we maintain that access to the City of London and build on that, what I'd say up to date has been a very strong relationship and indeed a positive relationship for both the UK and Ireland. Thank you very much. And I'll bring in Senator O'Reilly with a quick intervention. If you have it now,
Thank you, Chair. I was happy if you wanted to take a new batch. No, that's fine.
It's one round because we have another session.
Thank you. Thank you, Chair, for the opportunity. My welcome to our guests. Thank you for being here. My apologies. I had another meeting. So if I raise something that you've already painstakingly dealt with, please understand. Anyway, I think it's important, given that we're in public session, that people get answers very clearly, even twice to the same questions. People are very anxious about this issue. I come from County Cavan, where it's a particularly serious issue, and it's already almost depressing. Not almost, is depressing the local economy, the expectation of it, the fears around it, and all of that. So, where I live, the constituency I live in is Cavan-Monaghan, and it is already depressing that economy and would be halting potential expansion because people are unsure as to where they will go. So there's so much there. There's a litany of problems there and a litany of dangerous results, apart from the one that's not your brief, which is the macro issue around the Good Friday Agreement and peace. It is your brief, and the fallout from it is your brief, but the actual mechanics of that are not strictly your brief, so we'll stick to the relative, nearest as we can to financial matters. So just that was the context for my questions. Could I ask you, and would there be any merit, say, assuming a hard Brexit, in looking at your lending rules as a stimulus to the overall lending guidelines as a stimulus to the economy of that border region and indeed of the country? Is there potential in a change of lending policy then, and almost a kind of a Keynesian solution at that point in terms of injecting money into the economy, or have you given that thought? I'd be just interested in that. I know Teagasc has done this research on this, but would you have you quantified again the implications for the agriculture and the agri-food industry? And have you, I suppose it relates to my previous question about lending rules, etc., have you thought about potential solutions there? Have you looked at the question? I anticipate, and I already would think, that there's a lack, while there's an increase in, anecdotally I see an increase in property prices in the region, my border region that I live in, but I sense that they're being halted. There's a slowness, a remaining slowness, because of the apprehension that's there. Have you thought about the implications for property prices, and do you see a fall in property prices post-Brexit? And is there a reason for an alarm around there, and would you want to venture a solution or a commentary around it? It's not an easy one. I'm interested in the whole question of financial services also. Do you see, or could you quantify for us the degree to which financial services are migrating in here by virtue of what's happening with the potential for a breakaway by the UK and a hard Brexit? Are we gaining there? And if so, is there any joy for my region, without being ridiculously parochial? Would you see any potential for a location of potential new financial services in that region, but in the country generally as well? Could I ask you what you think of the implications and how it will work, the currency question, as we try to navigate? We'd like to be navigating a seamless border, but as we try to navigate a hard Brexit. And I did mention agriculture. Could I ask you the last question? Because there is genuinely very genuine, and this has not been alarmist, and it's reflected in all of the meetings I've attended with local sectoral groupings when they do our pre-budget briefings, when they meet us as Oireachtas reps, right across and all public meetings. There's a gloom and an apprehension and a fear around it, particularly in the border region. Now, I know it's national also, as is reflected in all of the contributions, but could I ask you, are there any potential opportunities for the border region? Is there anything that I could come home and tonight and say to my neighbours, and they say, what were you doing today for us, the great taxpayers of the country? And I say, well, I was at a meeting with the central bank people, and they told me that we had the following potential in a post-Brexit scenario. Or sadly, they told me we don't have any potential. So I'd be interested in your answer to that. Please God, and that none of this will be, that at the end of the day, none of this will apply, but we can't afford not to be ready. Thank you. Thanks, Chair.
Senator O'Reilly, and I'm sure the great taxpayers of Cavan are very grateful for all your continued efforts, indeed.
Thank you, and yes, thank you.
Election coming.
I'd like to welcome Senator Craughwell back.
Central bank to Cavan. Yes, absolutely.
Like
that's a potential solution.
Thanks. I'd like to welcome Senator Craughwell back. I believe the Seanad has been adjourned for a stint, so it's good to have a full contribution. Without further ado, I'd like to invite yourself, Mark, or your colleagues to perhaps address some of those questions, if possible.
Thank you very much, Chairman. Thank you, Senators. This is very wide, very relevant. Every single question is extremely important, extremely relevant. What I'm going to do is I'm going to group them a little bit, starting, I think, to provide really the baseline for all of the answers by providing what you asked for, Chairman, and in terms of our overall macro estimates if the no-deal scenario materialises. I'll move from that to some of the questions you asked regarding particular regions, particular sectors, particular issues such as a land bridge issue and how these might impact on different parts of the economy. There were some questions also about the property market and how the bank's rules in that regard might play a role. And I'll also discuss, and there were some about what happens in the event that a deal is agreed. What are the potential opportunities, and maybe what are some of the risks in terms of maybe for the multinational sector in terms of the tightening economy in that regard. I'll then pass on to Gina for some of the questions regarding the financial system, and there were a number there, including some of these issues about our political influence, because I think we can only speak with regard to our influence at European fora, but Gina will also discuss issues regarding new firms coming here in the financial sector. There were a couple of questions about that. And then at the end, maybe I will, while Gina is speaking, I'll look through my notes. I'm sure there will have been one or two specific issues I wouldn't have overlooked. I'll try to address those at the end, if that's an okay way to proceed. So let me just give some of the, a little bit more detail about what we think would happen in the event of a no-deal Brexit. So we distinguish scenarios where some form of deal can be agreed. In that case, of course, you will get a transition period till end 2020, so there's no material immediate negative effect on the economy. There was much more time for the economy to adjust, and then the effects are material but probably manageable and spread over the medium term. So we think that if a deal can be agreed, similar to the withdrawal agreement, then we would still expect strong economic growth over the short term as per our central forecast, and we expect that the negative impact compared to a situation where there had been no Brexit is that over the medium term output will be around 1.75% less, with around just under 20,000 fewer jobs. It is important to emphasise that that is in the context of positive growth elsewhere in the economy. So we still expect the economy to grow over the medium term, but by that amount less, maybe about 20,000 fewer jobs less. Most importantly is we think the effects will be materially worse in the event of a no deal, and that they will be front-loaded. You would see most of the negative effects immediately. The reasons being you would have a very sharp, immediate downturn in the UK economy, as scenarios produced by the Bank of England show. In addition, you would have tariffs on Irish exports and Irish imports imposed from day one, and those tariffs will be extremely high for the food and agriculture sectors in particular. You would also have immediate disruptions to whether it is regulatory checks or increased documentary compliance, all the forms of additional bureaucracy and delays in moving goods into and out of the country. So these would have material effects. A couple of questions came up about the economy's preparedness. The fact that the economy is not yet fully prepared, small and medium enterprises in particular, but also elements of the trading infrastructure, means that the most negative effects from these, we call them non-tariff barriers, the most negative effects are, and evidence shows this, tend to be felt immediately. Over time, the economy and businesses become better able to adjust to these new procedures, but the immediate impact can be disruptive. And I'll come back to the preparedness in a moment. So, in fact, we think that the disorderly no-deal scenario could knock around 4 percentage points off economic growth in the first year alone. So, to put that in context, we're expecting economic growth of around 4.25% this year, around just over 3.5% next year. So we would still expect some modest positive growth in the expected no-deal scenario, but essentially it would knock almost all of the growth off in the first couple of years. We think that the longer-term impact over the medium term, we think the effect will be output lower by a little over 6%. Compared to a no-deal Brexit scenario, and we think that there will be around 110,000 fewer jobs compared to a situation where there had been no Brexit. So the effects are immediate. Certainly
is that 110,000 indeed earlier 20,000 fewer jobs created, or a loss of jobs in the existing market?
It is fewer jobs than would have been the case. So it's on a net basis. And so it is maybe important to stress that we do still see positive growth for the economy under all scenarios, but by significantly weaker and significantly fewer jobs than if either ideally there was no Brexit or if a deal can be agreed. A very important factor relates to the fact that how those negative effects are distributed, and very clearly the agri-food and agriculture sectors, and those regions that export most to the UK and those regions that have a high degree of concentration in exporting of agricultural products are most affected. And from a regional perspective, the border and Midland and Western regions are most affected. So, for example, in the broad agri-food sector, employs around 170,000 persons. Around 100,000 of that is in direct agriculture. The remainder is in food processing and the like. That's around 7 to 8% of overall economy employment. In some border regions, that goes up to 20%. So you have very significant numbers of people employed in agri-food sectors, which export, probably around half of their exports go to the United Kingdom. So there are a number of reasons why agri-food sector is most impacted. First, as mentioned, about 42% of exports of that sector go to the UK compared to 11% for the economy as a whole. Second, tariffs are applied very differently across sectors, and they're far and away the highest tariff rates are imposed on agricultural products. So tariff rates on agricultural products could be up to 50 or 60% for some elements of the dairy and the beef producing sector. In addition, these non-tariff barriers, if you think of the nature of agricultural exports, often they're fresh foods, foods that need to get to market quickly. So additional delays, documentary compliance and the like creates particular burdens for these sectors. And finally, of course, there are parts of the agriculture sector that are not particularly viable at the moment. The degree of profitability, the margins being earned are quite low in parts of the agriculture sector, particularly beef, which indicates that they are less resilient to the type of shock that Brexit might give rise to. One question referred to the land bridge case, and in fact we do have some estimates as to quantifying the impact that this can have. So we published a paper on these what we call the non-tariff barriers. They show that in the case of a no deal, an average increase in a transport journey could be around 5 hours. We have estimates that these barriers alone, regardless of all the other effects, these barriers alone could reduce Irish UK trade by just under 10%. That's
Can I just interrupt you there? 5 hours, that's 5 hours on either side. So 5 hours at Holyhead and 5 hours at Dover, or is it 5 across both?
There'll be 5 on the overall.
Okay.
The overall. So around 2/3 of Irish exports to non-EU countries use a land bridge. Go through, around 2/3 go through, so it's an extremely important issue in terms of these additional costs. So the border region is clearly most affected. The issue of the backstop came up, and I'm happy to take any additional questions. For me, it's so much more important from a political perspective than from an economic perspective. Ireland's trade with the UK, with Northern Ireland, of course, is important. It's maybe around 1.5% of our overall exports go to Northern Ireland, probably about the same in terms of our imports come from Northern Ireland. So the least disruptive the border controls, the less the effects on our trade. So it's important what kind of arrangements materialise, but certainly I think the political dimension of the backstop in the context of the Good Friday Agreement dwarfs the economic effects. I think the economic effects I've highlighted are important regardless. The currency issue came up in a couple of questions, and it is very important. So the sterling is now around 16% weaker than it was at the time or just before the referendum. That would have created a much more difficult situation for Irish exporters in terms of competitiveness of exporting into the UK market. In fact, Irish exports have held up quite well to the UK since the referendum. The risk arises in the event of a no-deal Brexit, you could get further significant weakening of sterling, which added to what has already occurred could create a very difficult situation for Irish exporters, particularly in agri-food sectors. We do not forecast what might happen in the event of a no-deal Brexit, but I think it's quite clear that in the event of a no-deal Brexit, you would have further weakening of sterling, whereas if a deal can be agreed, the markets would probably be pleasantly surprised, and you might probably get some strengthening of sterling against the euro. So that very much depends on what Brexit scenario materialises. In terms of the property market, I think we have seen a slowing already in the property market. In terms of property prices, I think this backs up what you say, Senator O'Reilly, in terms of what you're seeing. We've had strong increases in recent years. The rate of increase has slowed. That's an economy-wide phenomenon. It reflects two things. It reflects first that more supply is coming on stream, and it probably reflects also the central bank's measures, and affordability pressures generally become more acute as prices rise. In terms of the outlook for property prices, we don't think Brexit may have some minor effects. So if there's an economic slowdown overall, that could have a negative effect on property prices through its impact on demand. On the other hand, within Dublin, the increase in demand for accommodation from workers in new financial services may put some upward pressure on houses within Dublin. But overall, I think that the impact, the evolution or the path of house prices will be affected more than anything by more supply coming on stream in the coming years. We expect to see this continue. We do review our mortgage rules every year, but our latest review last November, the main finding is that these are critically important for financial stability reasons in order to protect borrowers and lenders from excessive lending, over-indebtedness and the type of problems that grew up during the early 2000s. I think if you have a limited supply of housing and the response is at more and more credit, the credit starts chasing the prices up. It doesn't create more houses. There's no more availability of houses. So I think these are an important check in the market to prevent the return to the past. But certainly I think in the event of a no-deal Brexit, then we've provided our recommendations in terms of appropriate budgetary policy, fiscal policy and the like, and certainly in the event of a no-deal Brexit, you would see some room for discretionary spending, for example, towards most affected targeted areas, and maybe that's the most appropriate way, most direct and transparent way of dealing with that type of issue. Let me just mention one more point, and then I might pass on to Gina. So, in the event that that scenario is avoided, okay, following your very final comments, which I could not agree with more, that we hope that the no-deal Brexit is avoided. So there is a lot of uncertainty. Another question about the uncertainty, people holding off on investment decisions. We do think that is the case. We think there's a lot of uncertainty, a lot of enterprises, small and medium enterprises in particular, it's probably not worth their while to be making long-term investment decisions until they know exactly what form of Brexit materialises. Likewise, in terms of preparedness, it's easy to say that small and medium enterprises firms should be prepared for all eventualities, but for smaller enterprises with lower profits, it's costly to prepare for an eventuality that may not materialise. So the degree of preparedness, undoubtedly, among small enterprises is not complete. There has been holding off in investment. So what you would expect, if a favourable deal could go ahead before October 31st, yes, you may get some economic bounce as a result. You may get the higher...
Is there any fear of a little mini overheat if that was to happen?
Yes, that is exactly what I'm going to mention in a moment, and I'm also going to come to the point about multinationals in this context, because I think the concerns raised there are very much on this upside scenario. Yes, this is something. So the economy is very clearly, in the event that a deal can be agreed, the outlook for the economy remains strong. The economy is clearly getting closer to full employment. The latest quarterly unemployment figures, which I prefer to the monthly ones, point to an unemployment rate of 5%. In fact, some of the monthly data point to an unemployment rate of 4.5%. As the economy gets closer to full employment, then the risk of overheating pressures, which manifests itself in wages and prices rising at too fast a rate, which causes competitiveness problems. It causes difficulties for firms in hiring more workers. We're also seeing increases in the vacancy rate, particularly among multinational firms. So our concern in that, our primary concern in that regard would be this kind of risk of overheating. We do not see it currently in the economy. If you compare now, there was a question about comparing now to 2006, 2007. We have very different economic circumstances. The economy is in much better shape at the moment. So economic growth is not now currently being fuelled by domestic credit expansion or by inflows of money from abroad. We do not have an overinflated construction sector, property sector, banking sector like we did then. But it is still a concern that we would constantly be monitoring. And maybe the best indicator relates to wages. So at the moment, wages are increasing at around 3% a year, which we think is a very welcome rate of increase. But we will keep an eye that that doesn't begin to increase at too fast a rate. And then the difficulties for multinational firms and also Irish-owned firms in attracting labour becomes much more difficult. There are probably one or two that I might come back to, but maybe in terms of some of the financial system issues. Gina, would you like to?
Sure. So I think, firstly, in relation to the question on authorisations and the level of activity coming here, so sometimes the headline figure can be a little bit deceptive in terms of the level of activity that's coming here, but there have been over 100 authorisations in relation to Brexit so far, and there still is a significant pipeline in terms of the applications that we're still considering. Now, they range very much from the big banks and insurance companies whose names are already in the public domain, to smaller investment firms and payment firms. So there's quite an array, from small 1-2 person shops to, much bigger operations. And from an authorisation perspective in the central bank, obviously there's significant varying degrees of activity and engagement that we would have on those firms depending on the level of risk that they would bring into the system. So some of those applications would be turned around in a matter of days. Some would, obviously be much more substantive processes in terms of understanding the business models that are coming here and the type of presence that we would need in order to be comfortable with them. In terms of the changing financial landscape, I think it's probably well documented at this stage that on the banking side, for instance, that you mentioned specifically, we're moving from a more traditional retail banking focus to much more wholesale banking activity like the investment banks. There's also quite a few new firm types coming in the investment management sphere and asset management, so different kind of market infrastructure types. On insurance, there's been, some increase in terms of speciality type insurance around marine, aviation, those kind of new risks that we wouldn't necessarily have seen previously in the sectors. So that leads a little bit, I suppose, into your question in terms of building alliances, and I think that at a European level, and I'll speak specifically to the financial sector because obviously that's the piece that we're focused on at European level, it's very much dependent on an issue-by-issue basis and sector by sector. So in some sectors, we're very much an exporter of financial services from Ireland into the EU, and so we would have natural alliances with other EU member states in that regard. On banking, certainly at a political level, we would have signed up to various letters in terms of the Hanseatic League, and we would be of that persuasion at a political level on banking, and also very much a host member state in some issues in banking and how we look at prudential waivers and that kind of thing. So in terms of the UK and the continued engagement with them, as you say, Chair, we're very much determined to keep those strong relationships. We have them at working level on our working groups in the Central Bank at European level currently, and very much at senior level. And we have ongoing engagement with the UK authorities throughout this process, which has been extremely constructive, and we certainly intend to continue with those engagements.
Thanks very much, Mark. If you want to come back in, or
just very quickly ask Mark on the issue of mortgages and the control the central bank has over mortgages. So a debate that frequently arises in my own home, where you have a couple paying rent of, let's just say, $1,500–1,600 a month for a two-bedroom apartment or whatever, and they could buy it and mortgage it at 100% mortgage for $1,200 a month, leaving them with a net $300 in their pocket. Why do we not consider going back to 100% mortgages where the mortgage being requested shows a lower output than the rental that they have been paying? I've been looking at one particular couple, $97,000 in rent over the last 7 years, and they could have financed the property they're in quite easily at that sort of money. So I just wonder, why do you not? I've been told to go back to 100% mortgages. It's lunacy, but
sorry to intervene. We're drifting a little bit.
All right, okay, I accept that, but it is part of
just in the context of exactly what we asked Mr. Cassidy and colleagues to come in to discuss about. And indeed, I think it's quite important to remember what the work we're trying to do as a committee, both in terms of preparedness and providing solutions. I think we're just meandered a bit with that point. As relevant as it is to the overall economic outlook, perhaps the specifics might drift a little bit. But I'll invite, if you want to comment, I'm more than happy to allow you to.
Maybe I could say something, because it is a very important issue. So 100%. So for first-time buyers, as a couple of years, the deposit requirement is 10%. It's 90%. So and this is something we always try to highlight, because some people think it's 20%. So there is very strong evidence regarding the risk of default and how that depends on how much alpha deposit is required. The central bank has published a lot of analytical evidence on this, and it shows that, in fact, when the mortgage requirement, which I put it in terms of the loan-to-value, which is a loan-to-value of 90% is a 10% deposit, when the loan-to-value gets above 85%, the evidence shows the risk of default, the risk of those borrowers getting into hot water increases substantially. It means any reduction in house prices, any economic shock to incomes can significantly impact on the ability of that borrower to repay. So that's why we introduce this, to take account of the different situations of a first-time buyer. We have a deposit requirement of 10% for a first-time buyer compared to 20% more generally, to try to take that into consideration. So we do have strong financial stability reasons, and I think the 100% mortgages from a decade ago, in hindsight, were a bad idea. I think they did contribute to the crisis. There was only one point that I did not, and I didn't really come around to, just the positives, the opportunities as a result of Brexit. Really, the one opportunity, I would say that this positive is already incorporated into the numbers I gave you earlier, so it netted off some of the disadvantages. The positive for the economy generally is the potential for more inward foreign direct investment. So more foreign direct investment, either for firms that are currently based in the UK that wish to sell into the European market and will no longer be able to do so from the UK market, or for new firms wanting to sell in, which otherwise would have gone to the UK. Gina has discussed financial services. I have less in mind financial services here. I think we already have a thriving financial services centre. It's mostly located in Dublin. I'm thinking more about direct investment that could be spread more regionally across the economy. And the SOI estimates that it could have a positive impact because of Brexit of around 3% over the medium term. It's incorporated already in our numbers. That, for me, that positive FDI effect will occur if there's a deal or if there's no deal. So in terms of if there's any benefits economically from having no deal compared to a deal, I do not know any. I do not know any. I do not see any other opportunities. The only minor one I also see, I did not address prospects for the UK economy. I discussed the exchange rate, but generally the outlook for the UK economy in the event of a no deal is very negative. And Bank of England estimates suggest output there could be around 10% less than in the event of a deal. So I think we were already seeing investment, we're already seeing exports, output in the UK already significantly affected. So I think Chair, that's all I can find in terms of, but if there are anything I overlooked or missed, I'd be very happy, or we'd be very happy to.
I think that's all we can take.
I apologise for that.
At some stage.
Wearing you into submission,
No, I don't mean that in any flippant manner. You did cover quite a wide variety, both within your general remit and beyond, and to that we are extremely appreciative of your appearance today, but indeed your ongoing work throughout the last number of years. It's been a difficult few years into possibly even more difficult years, so our gratitude is heartfelt to everyone in the Central Bank. I think the conclusions provided by you this afternoon are vital to the ongoing work, and I think the ongoing awareness of exactly what we're facing into. It seems to me, unfortunately, as a society, be it the 24-hour rolling news cycle, or whatever it is we come in and out of our attention to what exactly might be looming on the 31st of October, and it's very important that all sectors of society, particularly in the economy, are aware of what could be around the corner, and that they actually do take the various preparations necessary that have been recommended. And to add to that, I really appreciate your frankness today, and your presence will be a great asset to our work as a committee. At this stage, I'm going to suspend the meeting for a couple of minutes just to allow the witnesses to leave the room and bring in our next set of witnesses. Thank you very much.
Thank you.
Excellent. I would like to welcome Mr Pat Ivory, Director of EU and International Affairs, and Mr Arnold Dillon, Head of Strategic Campaigns from IBEC, and Mr Neil MacDonald, Chief Executive of ISME here today. We'd be very interested in hearing. We obviously heard from both organisations in our first round of meetings over 2 years ago. We've just had a lengthy session with the Central Bank, but there's a lot that we'd like to hear what your organisations are doing and indeed your general overview. But before we begin, I do have to remind everyone once again of the rules on privilege, so please bear with me. Members are reminded of the long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the Houses or an official either by name or in such a way as to make them identifiable. By virtue of Section 17(2)(l) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to so do, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that, where possible, you should not criticise nor make charges against any person, persons or entity by name or in such a way as to make him, her or it identifiable. I'm going to take both opening statements together and then we'll open up to questions from the members. So first of all, I might ask Mr Ivory to deliver his opening statement.
Thank you, Chairman. Firstly, I'd like to thank you for another opportunity to set out the views and concerns of business on the crucial issue of Brexit. As you know, IBEC is the country's largest business organisation, and over recent years we have been working intensively to support our member companies as they manage ongoing uncertainty and plan for a potential Brexit disruption. In many respects, the headline concerns of business unfortunately remain unchanged since we last addressed this committee 2 years ago. Political developments have, however, crystallised the immediate risks. The failure of the UK government to ratify the withdrawal agreement has left business with the complex task and enormous cost of managing the uncertainty of moving Brexit deadlines. Millions of euro have already been spent putting in place and in many cases activating costly contingency plans. The divisive and ongoing polarisation of the UK political debate has increased the likelihood of a no-deal outcome, driving up the cost of contingency planning further. For the record, business supports the terms of the withdrawal agreement, which comprehensively addressed the key challenges that arise in the exit process and associated with that withdrawal agreement, the transition period. From the perspective of business, customs and regulatory alignment across the island of Ireland is vital to avoid the return of a hard border, safeguard the all-island economy and protect the Good Friday Agreement. Over recent months, our work to support contingency planning has intensified. We have produced comprehensive guidance for business and have hosted numerous events providing detailed expert insight into the complex issues that will need to be managed in such a scenario. While our members are very aware of the risks and are planning accordingly, it would be wrong to suggest that business, or indeed the wider economy for that matter, could ever be ready for the profound overnight changes that a no-deal exit at the end of October would involve. Despite the best efforts of business, successfully adjusting to a radically new trading environment with the UK is neither possible nor realistic, particularly for companies in the most exposed sectors in a no-deal situation. There are too many variables and unknowns. What we do know is that the imposition of very high WTO tariffs on certain goods, combined with additional customs and regulatory barriers, would cause major trade disruption. There is also the risk of increased illicit trade and smuggling across a whole range of products in a no-deal situation. Even in a worst-case scenario, no-deal scenario, we will need a phased implementation of new trading relationship and a compliance trajectory that minimises disruption. The political brinkmanship involved in setting non-credible deadlines has already cost business community. Additional collateral damage must be avoided. The European Commission claim that the contingency planning is complete, and they do not reflect the complex challenges on the ground. In this context, further measures are urgently needed, such as moratoriums to facilitate data exchange and flows, the rollover of current product labelling regimes, and other areas where it is simply impossible for business to change overnight. While most larger companies have comprehensive plans in place, many SMEs are ill-prepared. Despite major information campaigns, around 46,000 small companies of the 84,000 that trade with the UK have yet to register for an EO or I number that would be necessary to continue to trade post-Brexit. This is still a job to be done. While IBEX works to support contingency planning will continue, it must be stressed that very significant government and EU state aid intervention will be required to protect jobs and businesses in the case of a no deal. It is important that the European Commission and our own government have in place fully developed and comprehensive plans that can be triggered without delay in such circumstances. The economic hit will be immediate, so too must be the response. Certain issues have been addressed in the Brexit Omnibus Bill, such as the treatment of VAT on UK imports, but a much more far-reaching state aid programme would be required. This would need to include a new enterprise stabilisation fund to provide short-term financing support for affected companies, direct capital marketing and innovation supports for companies, or reorientating into new markets beyond the UK, and new trade support measures, including export trade financing and export credit guarantees. IBEC has set out in detail these proposals to government, and we continue to work with the relevant departments and agencies to prepare for all scenarios. As we move again towards another Brexit deadline, the macroeconomic backdrop remains benign. No other economy in Western Europe has greater momentum coming into 2019. However, a no-deal UK exit would significantly reframe the economic outlook and involve a major sterling depreciation, cancelled investment, falling consumer confidence, rising prices and significant trade disruption. It is therefore crucial that all efforts are focused on avoiding such an eventuality. Thank you for your time, and we look forward to answering any questions of yourself, Chairman, or the committee members. Thank you.
Thank you very much, Mr Ivory. Without further ado, Mr McDonald, I think we'll go straight into your opening remarks, please.
Ladies and gentlemen of the committee, thank you for your invitation to appear before you here today. I don't intend to provide a macroeconomic analysis of the effects of a WTO-style Brexit on small business. The economic effects have been well ventilated elsewhere. Brexit has been impacting business directly for the last year, stalling investment decisions, changing marketing policies, curtailing employment in at-risk areas and, most importantly, reducing confidence. In the case of ISME members, the quarterly business confidence indicator we employ to analyse business sentiment has not been so low since 2011. We thought this would lift after the postponement of Brexit in March, but it has not. Members told us that they had invested in inventory ahead of hard Brexit fears, inventories that are now being liquidated. They now face the same cycle again, building up inventories ahead of the October deadline without any clarity whether such inventories will be needed or not, sucking up working capital and management time. Brexit now ranks ahead even of insurance as a business concern for our members. While we acknowledge the political difficulties in concluding a withdrawal agreement with the UK when that country has not come to an internal agreement on how to exit the EU, we do need creative solutions on how to assist our nearest neighbour and our largest trading partner. The backstop may or may not be the material obstacle some suggest it is to the conclusion of a withdrawal agreement. However, Blind adherence by Ireland to the maintenance of the backstop could prove a costly policy if it proves to be the root cause in producing that which it seeks to avoid. We therefore ask you to be imaginative and flexible in your approach to what may be the end game discussions on Brexit. Small businesses lack the expertise, the bandwidth, the foresight, the finance, but most of all the time to carry out contingency planning for every conceivable form of Brexit. They rely on you, their political representatives, and on state and local authority agencies to assist them. More worryingly, many have adopted a fatalistic wait-and-see approach. The low uptake of EORI numbers, as you've just heard, is indicative of this. We are conscious of our duties as a trade association in helping SMEs prepare for Brexit despite the uncertainties. Brexit assistance measures are included in all our communications with members and on our roadshows. We have a dedicated website area for all matters Brexit, but members will need more than information in November. In particular, small business does not wish to take on more debt while addressing a problem that could reduce sales or increase the cost of sales. That doesn't make sense, but it does explain why the Brexit loan scheme has been less successful than you, the members, might have intended. Finally, we wish you well in the crucial 4 months ahead, and ISME will assist the members and the government in any way it can in preparing for Brexit.
Thank you very much, Ms MacDonald. I'd like to open up to colleagues for questions. If anyone would like to go first, Senator Craughwell.
Thank you very much. Thank you both for excellent presentations. I'm always amused when I vibe back in here because I spent a fair part of my life thrashing you guys through my trade union activity. But at the outset, I want to compliment both organisations for the tremendous work you've put in over the last couple of years in providing information to your members, in running roadshows, and part of the sadness of that is what you alluded to there, Mr MacDonald, a few moments ago, and that is the lack of take-up. People sort of hoping it'll be all right on the night type thing, you know, maybe it'll go away. It's like a colleague of mine in here believes there will be a dedicated carriageway both ways from Holyhead to Dover. We both know it's not realistic. One of the concerns for me from the IBEC perspective is the size of the soft balance sheets that are held in Ireland at the moment. I think Danny McCoy recently adverted to some 40% of the world, the entire world's soft balance sheets are in this country. And with Brexit coming down the line, we have companies moving into Ireland from the UK, putting further pressure on accommodation costs, if you want. I made the point to the last group that were in here that we're having employment now, companies bidding again for employees in specialist areas. And rather than having a jobs market, we are now almost having an auction market for specific high-skilled jobs. And I really wonder about the damage that what we're all hoping we'll benefit from. Is there a latent aspect as these high finance companies come into the country and various other companies that they will finish up pricing Ireland out of the market, both from a labour cost and from a cost of living in the state? So I wonder, have ye looked at that? The border, Mr Ivory, you referred to a hard border, and it's an old hobby horse of mine because this country never had a hard border in its entire history. It had a highly militarised border, and I really do fear for the return of something similar, which would be, and by virtue of the fact that it was a highly militarised border, it gave rise to the black market, or these smuggling operations, because there were so many ways to get across it at the time. And I wonder about that. Particularly, I wonder about the danger of, for example, beef being smuggled, being brought in from Argentina or somewhere to the UK, being brought to Northern Ireland, which is again within the UK, and then being smuggled south, put onto trucks and sent to Europe as Irish beef. And if that happens, and if it's caught, I can't begin to think what it's going to do to us. I know that a number of the Chamber of Commerce, the international chambers that are operating in Ireland, are encouraging manufacturing to look to Europe for alternative sources of components. Have you looked at the cost of changing, say, component suppliers to European-based suppliers, and the quality? Are there issues with quality moving away from the UK as we try to source additional ones? The issue of the sea bridge versus the land bridge. We were given an estimate there today of the land bridge costing 5 hours. Sea bridge, I know certainly the Germans are looking at trying to get direct routes into Duisburg or Hook of Holland. They think Cherbourg or Le Havre are a little bit too far away from mainland Europe, so I wonder if you've looked at the cost of that for your members. The post-Brexit phase, at a recent conference I was told we could expect 10 years before this settles down. Have you guys looked at that? Do you have an estimate of how long you're looking at? Mr MacDonald, you referred to the backstop, I think, and the alternative that we might actually, the latent aspect of the backstop might be to actually make things worse. Do you want to expand on that a little bit? And have ISME looked at an alternative system? Would you prefer to see a border in place with proper checks at the border as against free movement over and back? That's really all I want to ask today. Chair, thank you very much, and thank you to both organisations for being here.
Thank you very much, Senator Craughwell. Senator Ó Donnghaile.
Thanks, Gerard. I really just want to, gentlemen, thanks for the presentation this afternoon. I just want to put to you the question that I asked colleagues earlier, and that is around the importance from an organisational point of view, and indeed the companies that you represent, around the backstop. It's really just to build upon what you have said already in reference to regulatory alignment, and there may be questions that come from that. But I just want to get certainly a corporate view, and indeed anything that you can expand upon in relation to the significance of the backstop. Thanks, Chair.
Thank you, Senator. There's just 2 or 3 little points I'd like to raise or ask, and one of them actually builds on slightly on what Senator Craughwell was saying. But the first would be in relation to, I suppose, your international contacts. I know IBEC are obviously members of Business Europe, and we hosted counterparts of yours many times who've come over to discuss this issue. And I suppose my question, without referring to, say, the CBI, but other in the remaining 27, to the degree that the solidarity has been maintained, and indeed how you're working with colleagues to, I suppose, develop the knowledge of the unique situation that Ireland will find itself in a post-Brexit scenario compared to continental colleagues, based on how heavily exposed our economy will be, both to the British economy, but through the British economy, and Senator Craughwell has at length mentioned the land bridge. And I suppose then I'd ask, in relation to, in April we saw the second extension to this process, and we throttle into October 31st, not really knowing what's going to happen in the UK. That might be clearer in the next few weeks, but it might also be a bit less clear. And it was actually a point, Mr MacDonald, you made at length in relation to inventory. That's something I came across quite starkly. A friend of mine owns a second-hand used car dealership, and obviously he brings a lot of stock in from the UK. He stocked up, and now he spent the first quarter of this year trying to get rid of it. I think he's done okay, but let's put it this way: there was no summer holiday for him or his kids this year as a result. And it's whether we look to the period that the extension is welcome because it avoids the cliff edge, and we all know how bad a cliff edge, uncontrolled Brexit would be. But equally, how damaging is the uncertainty? And is it the uncertainty, or is it more the fact that in a parallel stream people think that the threat has gone away, so they stop preparing, or indeed they say, oh well, it will keep getting pushed on. At some stage this process will end. It will end through an agreement of a deal, a no deal, or indeed the UK revoking Article 50, but it will end at some stage. And is it a little bit like the boy cried wolf? Like, by the time it eventually does end, will there have been so many extensions and possible endings and uncertainty that it just has added to the overall confusion? And indeed, how can that be got around? And I suppose, I suppose the last question is in relation to the work that you both mentioned, the work you do with your member organisations, and indeed the engagement you have with government. And I know we sit beside each other at Brexit stakeholder forums, and we've all been to the roadshows as Senator Craughwell has made. But how prepared can business really be? You know, is it at the stage that we'll never be fully prepared, and that's why when 6% of people say we're not prepared, or only 6% of people say we're prepared, it's because no one really knows quantifiably what they're preparing for? Or beyond, you've stressed the information and the legislative matters, but I then put it back to when we talk about state aid packages from a government side, how exactly do we need to prepare those state aid packages when in turn we don't know when we'll need to make those changes, or indeed when this process will end, when state aid is required, and how can we best calculate that? And I'll hand it back over to Mr. Ivory if you want to.
Yeah. About the inventory, Chair.
You can answer.
The cost of building inventory and then having to dispose of it because it's been pushed out. Yeah. Holding inventory is always a cost. So you're going through these cycles. And when you're addressing that, Mr. MacDonald, you might just address the cost that your members are experiencing on that. Sorry for jumping in so quick.
Said like a good quartermaster.
If your mate has a good car, give me a ring.
I appreciate that. Yeah, no bother. He has a few. I'll advertise him later in private session. But Mr. Ivory, then Mr. MacDonald and Mr. Dillon, if you'd like to come in as well, it'd be appreciated.
Yeah. Just maybe just to take up your point on relations with other business groups across Europe and the degree of solidarity that there is around the current position. I was in Helsinki this time last week for a Council of Presidents of Business Europe, and in addition to the actual formal meetings of the Council of Presidents, we also had a number of bilateral meetings with key strategic business partners. And I'm pleased to say that there is very strong solidarity among European business, that we all continue to support the acceptance of a withdrawal agreement with a transitional period attached to that, and obviously part of the withdrawal agreement is the political declaration. And there is, I think, further room for manoeuvre and for negotiations on the political declaration element of the withdrawal package. There is no sign of any business group within Europe moving away from that particular position, and there's very strong support for the Irish backstop. And that being part of the withdrawal agreement. I mean, in addition to meeting with our business partners, we've also, in the last few weeks, met with the European Commission's Brexit Task Force and the Council's Brexit group, Brexit unit. And the clear message from all of those meetings is that the withdrawal agreement will not be reopened for a negotiation. And on that basis, our advice to members is that you cannot rely on this impression that is sometimes given in the UK that a new UK Prime Minister will simply be able to reopen negotiations and arrive at a different deal. Our view is that the deal that's on the table is a good deal, and there's no sign of either the Commission or the Council or indeed the Irish Government moving away from that position. So therefore our advice to our members is that the possibility of a no deal scenario has increased, and that we need to continue to deepen contingency planning for that. In terms of the one of the questions I think that Senator Craughwell asked was how prepared are business? Our view is that in terms of contingency planning, a lot of contingency planning has been done by large companies. A lot of money has been spent on contingency planning. The European Commission has published a lot of documents on contingency planning. Our own ports, our own infrastructure here in Ireland has taken significant steps in terms of contingency planning. Our customs and revenue people have taken significant measures in terms of contingency planning. But despite all the best efforts of the authorities and of business, it is our view that nothing can prepare for the catastrophic economic impact of a no deal. And in that context, we believe that further measures are required, and we have said this both to the Commission and the Government. The measures at the Commission level, we feel that there is a need for some sort of agreement in terms of data flows and data exchange, personal data, etc. Some sort of, while an adequacy agreement is going to be negotiated between the UK and the EU, there should be a moratorium, a freeze period when data can still flow across borders, because otherwise we don't understand how business is actually going to operate. And also then in issues like labelling, you cannot change labelling overnight, and many other compliance issues. So there has to be a compliance trajectory, and there has to be some sort of period after a no deal where a sensible approach is taken in order to enable business to keep going. I might just invite other comments then.
Maybe just on a couple of points you raised, Chair, about the mood in business with regard to the rolling extensions, and clearly there is an obvious frustration there and a challenge in terms of actually managing people and managing resources in terms of trying to stay prepared. The one thing I would say is, though, I think that business does appreciate the approach of government on this and the importance of the backstop, obviously from a political perspective, and the implications with regards to the Good Friday Agreement. So the one point I'd say is I think there is an understanding that while the frustration and cost involved in those deadlines is painful, I think business is happy that extended deadlines be granted if the alternative is a sort of impact of a potential no deal and sort of ramping up the tension around that sort of element of it. And just returning to one of the earlier points made just around the wider sort of economic issues that arise in the context of perhaps new investment into the country, particularly in the context of Brexit and financial institutions. I would say that we've set out, these are very big issues, ones that IBEC and the business community are incredibly cognizant of, and we have set out very significant and comprehensive proposals around infrastructure. I think that we need to make sure that the economy and the wider country is able to absorb any sort of inward investment, but also the talent implications that it has in terms of squeezing the labour market and squeezing the talent pool. And as I say, we've set out very comprehensive proposals around that, and more than happy obviously to send them in and circulate them.
Thanks very much, Mr. McDonald.
Chair, if I just take them in the order they came up. So as to the soft balance sheet issue, as things stand in the country right now, small business sees themselves in competition with, we're effectively in a three economy. So there's the small enterprise economy, there's the multinational economy, and there's the state and semi-state economy, where the CSO figures, state employees are paid 35% more than private sector workers, and multinational companies pay a premium above that again. So our people complain about trickle up in the employment market as it is. If Dublin was to become a refugee centre for even more big entities from London, that situation would be exacerbated. So we don't know. We see it. We're based on Kildare Street, and you can see what's happening to Molesworth Street now yourself with the number of entities coming in there. On EU suppliers, just to echo the point that Pat made there, to give you a practical example of this, I have a member in the cosmetics distribution business in Ireland and they're distributing a well-known, a household name French cosmetics range, but which is packaged and labelled in the UK for the UK and Ireland market. It also, interestingly enough, which is an area which has not been given, although my members have raised it and we brought it up with DBEI, there are also commercial arrangements in place, licensed distribution arrangements in place for UK and Ireland, which are held by UK companies. We've said this to DBEI, that there may, in the event of a hard Brexit, some of these contracts may become unenforceable, or a UK company may try to enforce a contract that's a distribution contract that's unenforceable in Ireland. So there are all sorts of issues here. But in terms of, French cosmetic products, they have their standard markings and their English translation applied in the UK. It's not to say that that can't be replicated here or done somewhere else, but it will be done at a significant cost. Alternatively, the UK will just agree to continue doing it and abide by the standards in place. But of course, that's a political consideration. On the backstop alternatives that I was asked about, the backstop, the difficulty with the backstop is there are political. This has taken on now a Jekyll and Hyde sort of aspect to it. So the political aspect of this that has become unacceptable in the UK isn't fundamentally an area that small business occupies a lot of time with. So the political difficulties with the backstop, as it's called, have taken on a life of their own, whereas what the backstop is to try to do from our Irish perspective is it's an insurance policy, a contingency policy against something bad happening. So we see the backstop as a practical end insurance policy against a bad event. And there's a total disconnect between those two, the political imperative and the practical imperative. So to put, we discussed outside, the phytosanitary. So what do you do with beef crossing the border? I think there's an acknowledgement that on the island, there's going to have to be an all-of-island approach to that. Where it gets interesting is, for instance, in service businesses, and I know I'm dealing with some trade unionists here. So let's take, we have a building company in Northern Ireland which decides in the brave new world it's not complying with the Working Time Directive. Is that going to be capable of tendering for business in the Republic? These are practical and legal considerations that are actually going to bother some of our members if Northern Ireland companies have the freedom to opt for particular regulatory regimes that are actually potentially anti-competitive. If our people are held to a 48-hour average working week and that disappears elsewhere. So standards then are a huge amount of the equipment purchased in our health service will have British standards on it in high-end kit. Those difficulties go away if there is going to be mutual recognition of standards. But we have already complained to the Office of Government Procurement and to DBEI in relation to so-called Brexit proofing of contracts. There are tenders coming out now saying, from state and semi-state agencies, saying we want you to insulate us against possible consequences of Brexit in the purchase, for instance, of fixed assets that might be purchased under a British standard now. Is that standard going to be acknowledged into the future? Those things for long life assets have huge implications. And the political point I made about the backstop is, we, the Irish, when we voted down voted no in some European referenda in the past for our red lines, we did actually succeed in getting opt-outs which we're able to politically solve the way through for us. So I would like to think that something like that is achievable for the UK. Chair, you asked about the international impacts. Like IBEC, we are members of a European Business Association, SME United. I have to very honestly say that once you go beyond talking to the Dutch and the Germans, there isn't a huge amount of concern at all. Intellectually and in business terms, they've moved on, and indeed some of them, I think some of the difficulties that any form of renegotiation is going to take is that people see commercial advantage in the UK leaving. So the notion that there will be hands across the channel in helping the UK, I think, is a bit fanciful. This is not a significant concern outside the immediate kind of Dover-Calais area. The cost of uncertainty, it's impossible to put a euro cost on it, Senator, but if I put it this way, if you remember at the back end of last year, the UK became the biggest purchasers of refrigeration in the world for medicines. So you can actually start to put a high quantification on it there. We ran out of, Ireland ran out of warehousing space. And nobody is going to build a warehouse for something that mightn't occur. So what you're going to have is what's classically called rationing by price, and those that can afford to build inventories will do so, and those who can't won't, and they'll accept the consequences. The state aid, most of what is going to be required is around working capital, and again our people are extremely reluctant to take on debt. And that's actually going to be tricky to achieve within state aid rules. I'm very conscious you can't just be handing out money. But how prepared can businesses be? Well, the simple answer is that not all businesses can be prepared for every eventuality, and I think we have to be. Business actually has a tolerance for bad news. They just need to be told it directly and honestly. It's not the same political considerations that you deal with necessarily in the electorate. People just want to know, quantify the worst case scenario, and they're happy to put up with bad news.
If I could just add on the point about the beef sector and the threat of Argentinian or indeed Brazilian beef coming across the border, I think that there's two things in relation to the border, and the backstop is part of addressing this, and that is that we have responsibility too, as members of the European Union, to protect the integrity of the single market. And that is going to be a very challenging and difficult thing to do in a no-deal situation. But these are the kind of challenges we have to look at. Also, in terms of regulatory, it's not just about customs, it's also about regulatory alignment. And in relation to the whole food sector, the dairy sector, the beef sector, and the infant formula sector, all which are hugely important parts of Irish industry and very important in the border, around the border counties as well. There has to be action also by our state agencies, by the veterinary authorities on SPS issues, inspection issues. These are all complex matters, and further work has to be done on this, because our information would be that while quite a lot, for example, customs and the revenue commissioners have introduced a 24/7 employment arrangement with new customs officers, that they're going to be available right around the clock 7 days a week to facilitate stuff coming in and out of our ports. Are our other agencies at that level, and will SPS and inspections be able to match that kind of role? And that's a question which we have to look at. In relation to the impact and where the impact will be felt, I mean, the regional impact is extraordinarily important. I mean, in the regions, if you take, for example, the Cavan-Monaghan region, 33% of people employed in those regions are actually in Brexit-exposed sectors. So therefore, we need to address those regional concerns. So, and again, if you go further down the country, as you go into the south and the Midlands, you will get a lot of emphasis on food production, on spirits and drinks production, all of which could be impacted by this. One of the stabilisation mechanisms which we are proposing in the upcoming budget is that they should take into account the impact on workers. And what we are proposing, for example, is to prepare a short-time work subsidy scheme for 2 years initially for vulnerable workers in the event of a no-deal Brexit. And we're also proposing the introduction of an employment subsidy scheme with subsidies up to €10,000 over 24 months by employees affected in distressed firms. So I think we need to address a whole range of measures, and in addition to the kind of capital, the working capital and access to finance that Neale mentioned. Thank you.
I'd like to thank all three of you for your presentations and frankness today. It's greatly appreciated. A lot has changed and not much has changed in the last 2 years since we spoke, so it is really quite appreciated. At this stage, I'm going to suspend the meeting briefly to allow our guests and those in the gallery to head on, and then when we come back, we'll be in private session. Thank you once again.